In the last 6 months, the S&P has risen over 20%, warranting that some people are saying that we're in a new bull market. However, there's overwhelming evidence that the recession still has way more pain to bring, and that there's an indicator that has 100% accuracy over the last 50 years for counting every recession, and it says that we still haven't seen the worst yet. Hey everyone, welcome back. Before we get into the video, make sure to follow our Twitter and newsletter so you can get more updates on the markets that don't make the YouTube channel. Both the links will be in the description down below. So as mentioned prior, since October of 2022, we have seen a rise in over 20% in the S&P 500, warranting a lot of people to say that we are in a new bull market. Now, if you look back in history, which we will here in a little bit, there have been multiple 20% rallies in a bear market, and sometimes not even in a bull or bear market, just kind of consolidation zones. So while yes, the stock market has been resilient and there are still talks of a soft landing going on, I still think because of all the indicators out there and all of this prolonged pain that has been, it's kind of like these weird headwinds that have been going on. I still think that there's more pain to see in the markets. Now, if we go ahead and time travel to 2000, where the dot-com bubble happened, this is an example. This is a great example of why 20% rallies can happen in bear markets. And in this one alone, 3 of them happened right around here in March of 2001. From the bottom all the way to the high, there was a 22% rally. Literally immediately after that, right here in September of 2001, we had another rally that lasted around 25%. And then the final rally all the way over here, July of 2002, we had another rally of around 25%. Now, when you take all of this into account, basically going from left to right, it lasted around from the peak right around here all the way to the bottom. Either way, if you want to say this is the bottom, it lasted around 770 days. If you want to extend it all the way over here, we're looking at 924 days. Now, I don't think that this bear market is similar to the dot-com bubble. While it does resemble some similarities, there's a lot of things and points that we need to look at that are different, but also points that prove that we still have way more pain to see than what we've seen right now. So this chart shows a great example of how long bear markets can last, at least for the S&P 500, typically aligning a lot with recessions. Now right here on the left in this blue, you can see that these are trading days until the bottom. We're not going to go over every year, but you can see down here the average that is gray highlighted. It typically takes around 318 trading days, which if you take trading days into normal days, that's over 1 full year. As of right now, we've only experienced 195 trading days that have been negative. So we're just a little around 2/3 of that. Now, if you look over here, we look at the drop in percentage. As so far, the largest drop that we've had in this entire 2022 bear market, or the S&P decline, has been around 25%. And then if you look over here, the average is around 38%. So we still have more days and more decline to come if we're to reach the average, which again, you could see may not be the case because there are multiple times where we had less than the average. Another very important indicator to look at is that during bear markets, you also need to look at the price to earnings ratio for the S&P 500. Typically, during the bear markets, the price to earnings ratio is very low. Right around here in the 1920s, we had around a 5. Right around here, the 1932 post-crash was around a 6. 1980, when we had that double recession, was around a 7. And the 2009 global financial crisis, it was sitting at around 15 for the price to earnings ratio. Currently, we are sitting at 28 in 2023 for price to earnings ratio, a little bit higher even, maybe in the 30s. If you look left, that is higher than some of the peaks over here. I mean, in the peak of early 1900s, it was 22. In the peak right before the 1980s, it was 23. And again, the peak right over here was 43 for the global financial crisis. But it's hard to say that we are in a bear market or we've reached the bottom when the price to earnings ratio is sitting at around 30, which is absolutely insane to think about. Another important indicator that we need to take into account is that when the Fed actually starts to cut the rates or the interest rates, that's when the bull markets actually start. In the last 50 years, no bull market has started while rates are still rising. And as of right now, the Fed is leaning a little bit more towards a pause, but as of right now, it's still really a 50-50 kind of toss-up. And the rate decision comes June 14th, which is just a week away. Now, another thing to take into account is that June may be a pause, but a lot of people and even the Fed has said that just because they pause in June doesn't mean that they're going to stop raising in July and August, depending on how the data comes out. So right now, to think that we're in a bull market while rates were still rising and it's never happened in the last 50 years just seems a little bit out there. I still think that one, they're going to raise rates continuously into July and August. But also, to say that the bull market happened while rates were rising doesn't really signal confidence. And again, if we're looking at the interest rate hikes for June alone, it's looking like it's a 70% chance that they actually do just stay here and don't raise rates. But again, there is still a 30% chance where they do raise rates. And we've seen how crazy this can fluctuate. I mean, just a week ago, it was sitting at 80%, and now it's dropped around 10%. So sentiment can change very quickly, especially if the wrong data comes out. And again, the one indicator I was referencing earlier in this video, the 100% indicator for calling recessions is the 10-year to 3-year yield curve spread. Now you can see over the past 50 years, it's been 100% accurate, counting basically every single recession, even including this 1980s double recession. And it's at the lowest point that it's ever been, if you exclude the 1980s double recession, which shows a very strong signal of a recession coming. Now, when we take a look at when the recession starts from when the yield curve inverted, typically the average is around 12 months. And as of today, we're sitting at around 7. So again, if we looked at how long the S&P 500 can drop for, we saw that it was 318 trading days. And when we're looking at the yield curve inversion until a recession starts, we're still 5 months away from that, which again pairs up with the averages. Another thing to look at is the S&P 500 change after that 100% indicator inversion, or the 10-year 3-month yield inversion. A really big thing here is that you could see that while a lot of the stock markets, and we're looking at the current one, 2019, 2006, all the way back to 1969, you can see that a lot of these, some of them immediately just dropped, and we would just continue to fall and fall and fall. With 2000, the dot-com bubble being one of the most aggressive. But you could see for a while, some of these actually sustained some pretty long highs, but eventually, all of them eventually dropped into the negatives. And it was really just a scenario of prolonged pain, which kind of seems like what's happening right now. And again, a really good thing to do sometimes is just to take the average of what's happening, and that way you can kind of see the sentiment of everything wrapped together. Whereas the black line is the average, where we did see somewhat of a push to the upside, but again, eventually we did just fall back to the downside and made some massive declines. As of right now, since right around here, all we've been seeing is green in the stock market. A lot of that has to do with the AI boom, and also basically just 5 to 6 companies carrying the entire stock market. So what happens when their price to earnings shares fall, when their revenue falls, and they also start to take the rest of the stock market with it? Once that starts to happen, that's when we see a little bit more pain and the average start to weigh out. And again, we still have around, from what the average tells us, 5 to 6 months until the recession starts and everything starts happening. That also seems to pair with when the Fed could start cutting rates, which is always in correlation when the bull market starts to happen. So taking everything into account, I personally think, and this is just my personal opinion, where I think we're still going to see more downside happen. I don't think we've seen the worst yet. And I think it could happen within the next 4 to 7 months. And that's just kind of from what the data has been saying and everything like that. But that's everything I have for this video. If you guys did enjoy it, make sure to go check out our Twitter and newsletter. Links will be in the description down below. And until the next video, we'll see you guys then.